Politics. Come on.
All right, so we're ready to go, right?
Yeah.
Anybody need any water or anything like that before we get started?
I'll take a water.
I got to get you a water. All right, so let's get it started.
I'll grab you water.
I got it. Newbie Real Estate Investor Podcast, episode number 22. Woohoo! We're live.
All right. Guys, welcome to our episode 22. Oh my God, already. So we have a previous guest, Abdel. How do you say your last name?
Khawatmi.
Khawatmi.
Yeah.
All right. And then we have Lada Kobavella. Sorry.
Close enough. Lada
Yeah.
K.
All right. And then we have our usual host, Joe Fala. All right, so let's start off with some current events here, right? What do you see going on with rates today, since we have two mortgage guys here on the show today?
What?
Let's start with our guest.
Oh,
Go ahead.
I'll
Get
take it.
Yeah.
What are your thoughts? I'll piggyback.
So we'll start off obviously for the last week or so, right? For some of us who've been seeing a little bit
Rough waters.
Since Tuesday we're sitting at almost 8.25 was kind of where we were at, and then luckily the last 3 days, tail end of last week, we got a lot of data reports. So if you guys remember when I came on last, I had talked about the two main things that the Fed is really monitoring, which was inflation and employment, right? It was all about, are people spending money? Are people spending too much money? Do they need to continue hiking up rates? Is the cost of stuff still cheap enough and people still need to have the ability to pay for it? And then obviously employment, right? When we talk about that scary R word of the recession that we're 100% in and further heading into, are people losing their jobs? Is there less jobs out there? And is there less jobs being created? And that's exactly what happened Wednesday, Thursday, Friday, right? Tuesday, we got the JOLTS reading, which is job openings and labor turnovers, which came in super low. Wednesday, the Fed paused. Thursday, initial jobless claims actually was the highest it's been in 7 weeks, so almost 2 months. People are filing for unemployment. And then Friday, we got the BLS, the Bureau of Labor Statistics, which for the first time ever didn't actually come in as its alternate name. I call it the BS report, right? It actually came in and showed less jobs. So what happened to rates? They went from almost 8.1, 8.2 to like 7.4.
Yeah.
A very, very, very sharp decline. So when we were talking about it and you were like, hey, I'm like, can we come on? I was like, oh, this is going to be a great point to talk about, because I'm either going to be coming in with happy tones or I'm going to be like, the longer for higher, right? Is kind of where it's at. But that's been it. I mean, for the last 2 days, we kind of really erased some of those positive gains that we saw, which usually happens anytime the bond market rallies. There's a 10-year treasury auction that's happening. So that's usually what happens, where investors and conservatives start getting a little bit more. But that's kind of like from a full-blown perspective. Really, data analytics is what we saw. And again, the Fed paused, which is great. History has shown before in the past, when the Fed pauses 2 times in a row, usually takes about 3 to 4 months, and then we may potentially see a cut.
Okay.
So that's kind of what we've kind of seen in the past with recessions and things like that. So, yeah. But if you got anything to comment on that, but
Ditto.
Yeah, I think you were way more thorough than I thought you were going to be. So,
No, he hit it right on the nose.
yeah. So the rates went down to about 7.4.
Yeah.
Where is it at now?
You know what? I haven't looked
It's still
today,
there.
but it's around, I would say it's
We were just looking at it.
7.6. Is it around there? Yeah.
It's around
7.6.
7.4.
Yeah, I think it's usually. Oh, it's still 7.4.
The 10 years in the
so
red
actually
this morning.
today, which is good.
Yeah.
Yesterday it creeped up a little bit And then today, I guess the 10-year auction probably went really well. I've been in podcasts all day. But yeah.
I had a borrower that was trying to pull some equity out of a house. They're doing like a fixed HELOC loan that I have. And she said, well, they locked me in at 11 point and some change, whatever the case may be.
Yeah.
She goes, well, they said until I sign, until we close, it can change.
Sure.
I was like, well, what I'm trying to make a lot of these investors understand is don't, miss out on dollars trying to save pennies. You know what I mean? Because if the property, Joey, right, you would agree, if the property is going to cash flow, the property is going to appreciate, and we're looking at a quarter of a difference. We're looking at what, $75 difference on your mortgage payment that you can end up rolling into your rent roll down the road. Don't worry about the little minuscule things that are going to end up having you lose out on a good deal.
No, you hit it right on the money. It's funny. Did you guys just start doing fixed HELOCs? Because I think almost every other direct lender started doing fixed HELOCs.
We partnered up with the fintech company.
Okay.
So I literally just send an application. They won't give me access to any parts of the loan. I just see that the loan is progressing. It's a we mentioned also it's a CCM Equity Express loan.
Yeah.
I call it the 5 and 5. 5-minute application, 5-day funding.
Love it. Yeah. Yeah. We were very similar with a third party institution. And then we started doing them in house. But I feel like every
fixed rate?
Fixed rate.
Okay, cool.
Fixed rate HELOCs in house. But I feel like every IMB normally will have independent mortgage banker. Once one does it, everybody else does it.
Right. Everybody just follows each other.
But you hit it right on the money. A different podcast I was on, and we were talking about your typical FHA conventional mortgage, right? And then we were talking about investors. Right now, some of my DSCR bank statement P&L loans from an interest rate perspective is actually more competitive than a 30-year investment agency loan.
Right. Repeat that again.
So usually whenever you think of DSCR, debt service coverage ratio loan, right? It's technically no doc. Mm-hmm. It's got a cash flow and with rent roll and stuff, or a bank statement loan or a P&L loan. The only quote unquote con to it, right, is just interest rates are slightly higher. Yes. Generally.
Mm-hmm. In New Jersey, there's the prepayment penalties as well.
Yeah, with prepayments, yeah. So, but the other flip side to it is Fannie Mae, the secondary market, they came out, I think it was mid last year, and they put huge risk factors, LLPAs, loan level price adjustments, against specifically investment properties and second homes. So in some instances, I'll price out both. If a client qualifies, right, obviously the goal is to keep them in a regular QM mortgage, and I'll price it, and it'll be like an 8.625 paying like 2.5 points on an investment property because that risk factor is steep. And then I'll go DSCR or bank statement or whatever it is, and it's like 7.9 paying like 2. And then I'm like, oh, snap.
These are not actual numbers for full disclosure. These are just hypothetical numbers.
Hypotheticals. But in some instances, just giving context, usually you're thinking you're going the regular traditional mortgage route, and then you're doing it. And this is the first time ever that investment style mortgages, that the non-QM world, non-qualified mortgages, can actually compete with independent mortgage bankers. Right.
So how's that happening? Because I've heard other lenders say the same thing.
So what's happening again is it's the secondary market. It's super contracted. So there's something called margin compressions, right? And if I have to dim it down, tell me, because sometimes
I think for most of the audience,
they just want to know the rate.
Yeah, exactly. Yeah, I think you probably lost half the audience.
Yeah, we're on a positive trend where rates are going down. Long story short, inflation's going down. CPI and PPI report, consumer price index, producer price index for wholesale inflation has been slowing down. This morning we got CoreLogic and Black Knight, which are like two big data sources that track how home prices are going, and home prices are going up in terms of value, which is great. And they're saying 5 to 6% nationally, and I think Black Knight was saying 8%. But so we're still seeing, after 2020, 2021, 2022, and 2023, after teens of appreciations each time, we're still seeing home prices go up, right? Which the main caveat to what you're talking about it is the biggest reason why rates are, still kind of at that stubbornness is the Fed wants that sweet spot of 2% inflation.
It's not going to happen.
We're slowly ticking away. We'll never get to 2, like Joey said. But we're finally showing breaks. right?
Yeah.
Into that stuff, and that's kind of what we were waiting on. So
That's kind of why like those DSCR loans are getting a little bit lower than the conventional.
no, so the reason why DSCR loans are coming closer to conventional is because Fannie is kind of a little restrictive to investors. Because what happens is investors are coming in and scooping up everything, right? Aside from the big ones like BlackRock and all their places that are picking us up. So it's the first time that you always used to go, and there wasn't such a high cost to acquire rate conventional wise. That's no longer the case.
That's all the loan level price adjustments that got kicked in earlier this year.
Yeah, exactly.
Yeah.
So
I remember when I wouldn't pay as much attention to the adjustments when you're pricing people's loans, and now you just go in and it's just negative,
yeah,
negative.
a lot of hits.
A lot of hits, exactly.
But investors know too, right? You're copping a mortgage. I hate to say the typical, you're gonna refi, right? They're when, who the hell knows? But if we can keep getting some good rallies like we just got, could potentially be in 8 to 12 months, right? But investors know that. So now, rarely can you lock and not pay points. And I mean like creme de creme borrower, you may still have to pay half a point or a point or a point and a half, right? It's tax deductible, so you will take the tax rate. The podcast I was just on was with tax professionals, so we're really diving into that stuff. So it is tax deductible in terms of your cost of acquisition for that, but you really just have to compare those apples to apples and then see what gets you a better return. So
Again, I think it's just finding the good deals right now. It's making people work twice as hard, teaming up with the right wholesalers to get you the right deals, and the interest rates are just what they are. You know what I mean? It's kind of like getting married. It is what it is, right?
Yeah, you brought a good point with appreciation, right? So so when I'm talking to, especially if it's newbie investors, right? If we're dealing with investors, which I know is basically our audience, right? If it cash flows, you know that this is a property that's going to appreciate. It's going to consistently go up in value, and then you're going to borrow against it in 2 years, maybe even sooner, right? And as long as it pays for itself, which if you're getting a DSCR loan, it has to, right? More or unless you're going to take a pricing hit. You buy the house, right? And I was sharing before, we're going to start seeing when rates go back to 5 and 6s on the traditional route, you're going to go back to seeing 50, 60, 70K over, as is, screw you, take it or leave it.
Yeah.
Here, there's a lot more flexibility. So now we're doing a lot more 2-1 buy downs. But we're actually doing them. We're not just turning our camera on Instagram and we haven't shot a video in a week and I'm going to talk about 2-1 buy downs and have no idea what I'm talking about, like half the people out there. We're actually doing them and explaining them that the cost of acquisition and stuff like that, and then if the house overappraises, you could use that, increase the purchase price, do a 2-1 buy down.
Are you doing borrower paid?
We do predominantly seller.
Okay.
Off sellers concessions. Yeah. I don't think our institution allows borrower.
We announced it, and then like a week later, they drew it right back.
Yeah, it's tough. It's the seller that's easier because it's thrown in a piggy bank. Right. If we're talking about buy down.
It's in an escrow account.
Yeah, it's in a piggy bank. If you refi before, that escrow account gets refunded towards the principal. So it's not like the money goes to waste. But now more than ever, you're an investor. You don't want to fix something, unless it's cheaper. If anything, you might be in because you're like, dude, I'll send a couple guys to fix it cheaper. But half the sellers out there nowadays are usually picking up the property because someone passed away or is in a state or the kids don't want to do that. They're more than likely going to give concessions, right?
Yeah.
So you could get houses quick. Also, what we start seeing is a lot of price cuts. So we've been seeing a lot of price cuts, and I think it was just maybe the seller was a little unrealistic, with what they wanted to do. So if you're going in there and you notice a 25K cut, don't offer them less and go in raw, right? Offer them list and ask for a 10K concession or a 15K concession. That's going to give you the ability for that consumer. The client's not going to care that his rate's 8 because he's only thinking, well, my first year's 6. If it's a 2-1, then a 7, then this, and I'm saving $500-600 a month, take it that way. So, yeah.
Yeah, that makes a lot of sense because that happened to me recently, okay? Because we have a house on the market and we were, I would say, probably about a month behind to being on market. So had we listed the house a month sooner, we would have gotten rid of it at the price we wanted to, or even better. Because we didn't, we ended up having, so we started off at 425, for example. The biggest downside was that the house itself was basically a 3-bed, 2-bath, but the third bedroom was very small. So you could say a 2.5 bed.
Like an office.
You're right.
Yeah.
So that kind of hurt us a lot. Okay. The kitchen was renovated. The 2 bathrooms were like half renovated.
Okay.
The shower area was the original tiles. Not original, but it was renovated maybe 5 or 6 years ago, and we kind of left that because it wasn't terrible. But one thing we should have done was maybe put in a few thousand more and made that more of a 2022 type of renovation, right? So we didn't do that. I think that hurt us a little bit. And then, like I said, we went from 425 down to 400. It was about a good month or so before we did the price drop. We were very hesitant to do the price drop. Then we finally got it down to 400. No noise, no offers, nothing for about a good 2-3 weeks. Finally, we got an offer. We took that offer, and then before we even actually got it under contract, they said, no, we want out of this contract. So basically buyer's remorse.
Sure.
They got it out of the contract. We left it at 400 for another 2-3 weeks. Crickets. And then we said, oh man, this is bad. So
Price cut.
yeah, another price cut. Now we're down to 375. 3 weeks go by. Finally, we had somebody say, hey, would you take a VA offer?
Yeah.
We said, yeah, why not? What the heck? All the other offers were VA anyway. I mean, sorry, not VA, FHA. Yeah.
Similar
So
appraisal
yeah, exactly.
stuff,
So it's kind of the same thing to us, right? To the seller. So it didn't really matter much. So we said, sure, no problem. VA is fine. My business partner, he's a veteran himself, so he says no issue. He wants to help vets anyway. Sure. So finally, we get it after about 3 weeks. Took about a week and a half because the guy is actually active duty deployed, and the wife is like, close. He's out somewhere in the Mediterranean right now.
Oh wow.
Or 2 weeks
deployed.
ago. Yeah. So she's having a hard time getting in touch with him. That was the initial getting the initial offer. They gave us an offer. And
375.
Yeah, 375. And then we had an issue with the driveway. So the driveway was not, official. And so, my realtor checked with the town. He says, nope, the driveway is not legal, even though there is a driveway. But the curb, right, the part that kind of comes up,
sure,
that wasn't cut from the town. So that's where the suspicion came in. And so we dropped the price another 10 grand. So now we're down to 365. Yeah. And we haven't gone through inspection yet. So I don't even know where we're going to end up.
The appraisal hasn't been ordered yet?
No. So I don't know where we're going to end up.
I'm
shaking in my boots right now.
They're not going to care about the driveway on the FHA, as far as I know.
No, they're not going to care about that. We already gave them.
It's the CFO where the problem
the CO,
The CO is going to be where the problem might come.
We already got the CO.
Oh, you did?
Yeah, the CO is okay.
So you should be fine.
Yeah, the CO part is okay.
Is good?
It's okay. Okay. They're not asking us to fix this, fix that.
Nice.
We don't have any issues there, but it's really comes down to the home inspection.
Yeah.
Right? That's where usually, because I used to be a home inspector.
The laundry list of stuff comes out.
Yes, exactly.
Yeah.
That's
the inspection,
when,
not the appraisal itself.
Right.
Gotcha.
That's when they're going to say, this
electrical
is no
panels,
good. Yeah, electrical panels old. Exactly.
Yeah.
So
you guys
inspectors kill deals?
I used to kill deals. Let me tell you, I was a bad inspector. Meaning,
no. The way I look at it, I think you're a good inspector.
Yeah. No. Well,
people may look at it like he's nitpicking,
right.
but you're looking out in favor of the buyer.
I remember one of the first brand new construction house I did. This was probably back in 2008 or 9. Right.
Whoa.
And I went and did the inspection. The broker was actually the seller, the builder.
Yeah.
Okay.
Those are always fun.
And I went there. The guy came in, welcomed me. He's like, "Hey, how you doing? How you doing? Come on in, come on in." would you like something to drink? So really welcoming. And then after the inspection, after he got the report, he called me up. He's like, you fucking asshole. He's like,
Give me that water back.
exactly. So, I'm like, what? I was like, he was so nice to me though, but listen, I was like, look, your toilet, your water inlet to the toilet there was leaking. So you had a giant puddle, plus your copper spout was basically like green. Okay.
This is brand new construction?
This is brand new construction.
How's that even possible?
That's erosion, right?
Corrosion.
Corrosion, sorry.
Exactly, yes. So you had that, and then you had a bunch of crown molding. Basically, I was like his punch list, like for the builder to not, like, they basically just didn't finish. It wasn't like the work was terrible or anything like that. It was just like a couple of pieces of crown molding was missing, like not even missing. They were like just hanging, and they weren't nailed in. I still remember this, like, so.
But this 2008, I could just imagine what those W-2s look like.
Yeah.
All types of fax machine layers.
I mean, like the dishwasher, right? The dishwasher, when I went to open it, I pulled the whole thing out. I was like, holy crap. I was like, all right, you got to, nail it. No, not nail it, like screw it in,
Yeah.
And then the AC condenser outside had a big ass dent in it. I was like, damn, what happened? It got hit by a car or something? It had a big dent in it. So he probably found like a used one or whatever and put it in. He's like, fuck it, I don't care. Right. And then there were a bunch of, like, under the porch, the rear deck, basically. He had a bunch of nails and stuff missing. I was like, dude, you gotta nail it, because somebody walked there and just fall through with no nails. Stuff like that. It was just a bunch of stuff, and he got pissed. I was like, dude, I'm just doing my job. This was in Union, New Jersey.
A lot of new constructions, man. I tell clients, they'll be like, oh, we don't want to get an inspection. It's brand new. And I'm like, no, actually the new constructions are the one that you really want to get.
Yeah, they're even worse.
Because those are the ones where they're truly cutting corners. And you're looking at it and it's shiny and everything is really nice, but you're not truly diving in. And I get so many phone calls after the fact from clients who bought new constructions. And when you're doing that, you're dealing with the builders and you're dealing with top people who know how to get around, so to say. And not every new construction is like that, but
people pointing the fingers because there's so many different subcontracting.
Yeah,
and stuff
exactly.
Like that.
Yeah, because there are so many subcontractors and they're all working for way below market. Like, let's say if I got somebody to do a one-off house as a subcontractor, right? And he'll charge me, let's say, $12,000 to sheetrock the whole house. These guys are paying them $8,000 because he knows that there's going to be 10 houses that he's got to do. So he's like, okay, well, I'm making a calculation. I'm still making $1,000 or $2,000 on the job, so I'm okay. And then I'm gonna keep doing more.
But he's not all in.
More.
It's not like he's building some massive house like in East Rutherford.
No. It was just like a one-off thing. Yeah. But still, like, people cut corners regardless, right? So yeah.
Yeah, no, it's crazy you're kind of saying that because I have a buddy who's a home inspector. I've actually shown him inspection reports for some of the things like I was working on. He was just laughing at those inspectors, and like he's been hit so bad because so many people have been waiving inspections, and then like he partners up with realtors that he meets at networking events, but he actually like writes the report about what's wrong with the house, and you're like, stop killing my deals, because he actually tells the buyers like what's wrong with the property, every little thing, and then those realtors are like, well, we don't want to work with you anymore because you just mess up our stuff. And
the thing is, the home inspector, they're not there to kill the deal or whatever, right? They're just doing their job, letting the homeowners know, hey, these things are, there's something wrong with these things, or just be careful in the future, something might happen here. That's all they're doing. And most times, it's what we call in the industry CYA, cover your ass. Because if you see something, they're going to say something. That's kind of the thing, right, for them. So anytime, hey, there's a crack over here, they're going to say it. Yeah. Get a professional, whatever, to take a look.
Here's a good example. So my best friend bought a house in Hackensack last year. Small little radiator leak. Joey, where did that end up? What was the repairs on that? Small radiator leak.
I think about like $15,000 or $20,000.
Oh my God.
Yeah.
That was with an inspector. The inspector completely missed that small little radiator leak. Little leak like this big.
Yeah.
That a cat could, would drink from.
Pick up. Yeah.
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 Yeah, so it's interesting. We're starting to see a lot more. But again, going back to what we were talking about is, in whether it's 6 months or 3 months or whatever it is, if we keep getting these data readings, it's gonna go back to take it or leave it. Screw you. I've got a line of offers out the door who are gonna go as is. And so it's funny. I was hearing an interesting statistic. It was about, I think it was 50 million buyers in 2021 into 2022 were eligible to buy from an affordability perspective, right? We're talking about rates and stuff like that. Now it's dropped to like 23 million buyers. So essentially 27 million buyers are out the picture. But
And we're not even, and that report doesn't even give you the full perspective of it because you don't know what these DTIs are like.
And good point. And now it's still 23 million buyers. That's a lot of people, right? And we have less than 1 million homes out there. Probably even less than that.
Yeah.
Right? Maybe like 600,000 homes. So you're going to see once rates trickle down, I'm already seeing it, right? Mortgage apps are obviously going to skyrocket. That 23 million of available buyers is now going to tack on to say 35, 40. You're still going to have a tight supply of homes. Homes are going to go up at the same time, right? Because sellers don't want to stay in their homes. They want to upgrade, downgrade, whatever it is. But it's still not going to be cross-competing. And it truly just comes down to supply and demand. There's a shortage of supply, very high demand, even till this market right now. And we're in Jersey. So we lend throughout the nation.
Okay.
So I'm doing a lot of deals in Texas, Carolinas, Florida, PA, actually doing them there. And it's such a different market. Like when I'm talking to a Texas agent, we just closed a 1.6 in Texas and Houston, completely different. And it's not like here where, if the closing date is Friday and I'm like, whatever, hit me with a TOE. I could buy myself 10 days, right? Texas, the day of closing. If you don't close the day of closing, you have a null and void contract.
Oh, really?
Oh, wow.
Yeah. PA is like that too. So we'll do a lot of business in PA too. A lot of the realtors, and one of the tricky part too that I hate, many other states, Jersey's a very heavy buyer get an attorney state.
Yeah.
Right. You got to get an attorney unless you're, I don't know what's like the cutoff. Right?
I think
Mercer
South
County.
Jersey,
Yeah. I was like, is it like Mercer? Because sometimes Hunterdon is like but like over there's no attorney, so it's generally the agents versus the agents. And then, piggybacking into that, obviously now with the NAR lawsuit, that's going to create even more control for listing agents even further, especially if there's no attorneys involved. There's going to be no fiduciary true responsibility to a buyer. So, yeah.
Yeah, do you want to elaborate a little bit into the NAR lawsuit to you guys?
You want the basic version?
Yeah, just the basic version. I don't think we need to go too complicated.
Essentially,
here.
basically what happened is they were listing agents with the way that the attorneys presented it. The listing agents across the country, right, is not just in Kentucky, right? Was it Kentucky?
Yeah.
We're basically saying, listen, we're going to list your house for 6%, and then we're going to give whoever brings the buyer of the house half of my commission, right?
Yes.
But this wasn't a rule that was written in stone, or it's not, how do you say, it wasn't something that they were supposed, not that they weren't supposed to be doing it that way, but it wasn't a written rule. It was just something that was just common.
Yeah.
Right? It was just common to say that I can list your house for 6%, and everyone just ran with it.
Right.
And to some attorney and some some sellers out in Kentucky said, well, we're reading the language in this thing, and where's the rule that said I had to list it for 6%? And the attorneys presented their case well enough, and they won.
Okay. So meaning that let's say they go.
They basically said there wasn't any.
house.
They kind of presented it where it wasn't a negotiation type of thing. It's either you list it for 6%, or you go out and list it as a for sale by owner. Good luck having all these strange people knocking on your door all types of hours of the night and things like that. I'm not saying they're using scare tactics, but
Yeah.
Yeah, so I mean, take hours to talk on this, right? But
Sure.
real quick, I mean,
Just a simple version.
What this lawsuit is going to do is, I shared a video the other day. Realtors are leaving the business every 3 seconds. They're going to leave now probably every second or every 2, right? Because the reality of it is it's always been negotiable for your commissions. We've seen a lot more. Now this is only going to create Jersey's a dual agency state. So you're going to see a lot more listing agents grab buyers and sellers, right? Instead of getting a 6% commission payout, they'll get 4, right? But they're keeping that completely for themselves. But the true reality of it too is that it's the sellers felt like they were being taken advantage of because they were paying both a listing agent's commission and a buyer's agent's commission.
Right.
But the reality of it too is, you know, you're a seller, you have investment properties and stuff like that. Many times a buyer's agent is procuring the buyer, right? That's the
Yes.
wording that they use. So
Right.
when he's bringing them, they're usually bringing a well-qualified buyer, ready to rock, ready to go. They did the marketing themselves, whether it was purchasing online leads or referral base or whatever it is, to get you a buyer that is well-qualified, can get you to the closing table and so on and so forth. That is now going to either change the dynamic, or a true smart listing agent is going to tell the seller, dude, you got to still pay. If it's not 6, it's 5, right? Whatever the negotiation is, to get top dollar for your home. Because what you're going to start seeing is, listen, we're all in this business, to help a client, but you're in a business to make money. And you're going to start seeing a lot of buyer's agents deter clients. I see it now, the reality of it. Anti-Sherman Trust Act is not being followed. But a lot of buyer's agents are going to deter buyers from, they're only paying a 1% commission. No, that house has problems. You don't want to see it, blah, blah, blah. You know, as opposed to this, or the buyers themselves, you know, till this day are going to have to go to an open house, talk to a listing agent, and the listing agent, their fiduciary responsibility is always going to come down to the seller.
I think another turn for the market. I was listening to a podcast, the Housing Wire podcast this morning, and they're saying that it's another common practice is that the way it works is someone wants to buy a house, they ask a friend, who did you buy your house from, and then they mention the realtor that they work with, and then the realtor will work with their preferred lender. I think Rocket Mortgage is taking the lead on this, where they're actually getting the buyer to come to them first, opposed to the buyer going and looking for a realtor. Because they're kind of doing everything in-house right now.
I mean, Rocket's Rocket, right?
Rocket is killing it right now.
And UWM and all these companies. But, you know, Rocket, and I could say this because it's public knowledge, but Rocket takes brokers and then facilitates the realtors directly around them.
Right.
So, and I'm sure that's why UWM took a big push, because they don't do that, right? But it's going to change the dynamic. You're already going to see, right? I remember you did a post the other day, right, talking about realtors and compensation and stuff like that, right? That's throwing a wrench in there. Conventionally, you're always allowed to have dual compensation, where a realtor can be a loan officer at the same time. FHA passed in December of last year, also simultaneously the first time that a realtor can be compensated on a transaction again. But I think, again, what ends up happening is I own a mortgage licensing school. So I license people in the profession to get their NMLS license with the Department of Banking. And I deal with a lot of different real estate professionals who are trying to get their license at the same time.
Be careful.
You lose. No, but it's true. I mean, they're coming to me, to my school. They're trying to get licensed. Department of Insured school. It's all regulated. You lose focus, right? It's tough. It's really a difficult industry to try to perfect. You know, I say you can't do mortgages full time if you don't do real estate full time. Right. You got to be all in, one craft, one perfection. Like we said, 23 million buyers are still out there. There's still technically 1 million homes out there. So you're going to have the ability to find them. Trying to, I think, do a little bit of everything will certainly limit your focus in terms of your vision of how
You have to be all in, especially when you're on the lender side. You have to be all in on it.
Yeah. So.
Yeah, and the crazy thing is they're probably being like, hey, I can do both for you. It could be like a realtor and a loan officer. It's a plus. Meanwhile, it's like, I know certain things about lending and certain things about being a realtor, not really like all in to help you be a realtor and help you be a lender, knowing really all the programs, the way to get you the best rate. Kind of like even you were saying,
exactly.
Like conventional VSD, SDR, you run both.
those realtors will actually they actually will fall well into a Rocket mortgage type of brokerage because, you know, not throwing any shade, those guys that you talk to on Rocket Mortgage, they're not doing much work. They're just collecting documents, and then there's people talking to them through the headphones that they're talking to you on, telling them what to say, what not to say. You know, tell them you need to collect this, and they're not calculating income. No. They're not walking you through the pros and cons of a down payment assistance program. They're not telling you if your debt to ratio is at 55%, what the negatives could be of it. If your house appreciates, if your taxes get assessed and they double because this house was built in 1930 and now it looks like a HGTV house, how much it can assess.
Yeah.
They're not walking you through that stuff. They're just reading a script.
Yeah, they're not giving you that specialized service that
exactly
you need. You know, it's not customized to you.
Right.
You know, yeah.
It's the same in your industry. You know,
right.
I can just go to IKEA and say, yeah, I'll take that, and just walk away.
Right. Exactly. Yeah. Yeah, you can definitely do that. And then, you know, you can definitely design your own kitchen, but you're not going to know a lot of the small details that you really need to know. Oh, I needed to add a filler here at the end. I didn't know that, you know. The walls weren't straight. Oh, you know, now I got a big gap, you know, on the bottom, no gap on the top, you know. So small things. I didn't know that, you know, I had to, my 36-inch sink can not fit in a 30-inch cabinet. I didn't know that, you know, like stupid.
Not to blow your head up, right? So Joey and I went out to look at a house he was going to do some renovations on, right? And long story short, he actually he got a couple people come out at the same time, but you know, if you're early, you're on time, and if you're on time, you're late, right?
Yeah.
So we got there early, right?
Right.
And he was first, and he started walking through the house and giving his opinion on stuff. And then this other guy showed up to also, I don't think he was going to do just as much work, but some of the work that he was going to
it was just
pass
a
on
painter
to
or
you.
something, right?
And literally, like an hour in, the guy was like, "Well, whatever he said to do, I think is a great idea."
Yeah.
What?
Yeah, that's what he said. Yeah.
The other guy that was there to give an
build
estimate.
the rapport.
Right.
Yeah.
Well,
No, this is the other guy that was there to contract
the
the
other
job.
guy. Oh,
the
that's
contractor
hilarious. Yeah.
was agreeing with Joey. Like he was asking his opinion. He said, "Yeah, whatever he said."
That
Well,
was like
that's
literally
hilarious.
what he was saying.
Yeah,
Just
he said
like
that.
whatever he said.
Yeah.
He goes,
Oh my
"Whatever."
God.
I think what he just said would work great.
yeah, because what happened was basically there was like a desk, right? A desk area in a kitchen. And there was a open space so that you can fit a chair in.
Sure.
And then next to it was like a filing cabinet, right? And then you got a little counter. So it wasn't a big space. And the guy was like, well, yeah, I could buy I can go to Home Depot and buy like a cabinet front and then create, cut pieces of wood, create a door, and then add a panel. Like he was making it so complicated.
Sure.
And I was like, why don't you do this? Why don't I order from my cabinet company two cabinets? They'll be exactly the same, and we'll size it correctly. We'll put it in, and then we'll reuse the countertop you have, because that's what you want, and we'll put it in, and that's it. And it'll save you time and complication.
And money.
And money, too. And the guy was like, oh, yeah, what he said.
That's great.
So it was just, having experience. But at the same time, the guy didn't have the kind of experience that you needed, right? Because he was a painter. So he came in to quote the painting of the house, not to do the cabinets and do all this. It's kind of like me asking you for a quote, to renovate a house. That's not really your thing.
Yeah.
I can ask you for a quote on a mortgage, but not on a house, right? So it's kind of like two different things that has nothing to do,
Yeah.
But if
with
he
the guy.
was there just to do the painting, why was he being asked about cabinets and stuff like that?
Because the owner asked him to paint all the old cabinets.
Okay.
And so, I was also so my company, we can pretty much do everything, right? We can paint cabinets, we can install new cabinets, we can paint the whole house. So we're almost like a one-stop shop as compared to like strictly guys that only do painting. Like they can repair drywall and, little handyman stuff here and there they could do. But when it comes to everything else, that's why at the same time, right, the guy was asking, can I do your bathroom as well. So he didn't ask the painter to, nothing as far as the bathroom. He didn't ask him for a quote or anything. He only asked me for that. So he understood, like, okay, the painter is not going to retile my bathroom and all that stuff, so, yeah.
Yeah, you mentioned experience. I mean, that's in any time, right? Buyer's market, seller's market, homes, this, that. It truly just comes down to that. Your knowledge, and it's that elevator pitch. You have that first 30 seconds to win a client over with your communication, with your expertise, with what you talk about. And that's going to allow you the ability to be successful or not. And that's why, again, every 3 seconds, realtors are leaving the business, and 50 to 60% of loan officers have left and not renewed their license. Because people are very, very quick to automatically pick up the assumption. It's not even an assumption, it's probably the truth. That, people ask me all the time, oh, how are rates? I have no idea.
0 to 100. 0 to 100.
I always say, they're like, oh, how are rates? I have no idea. I got to check your credit score. I got to check what home type. I got to find out your loan amount. I got to find out your strength. I got to find out your loan type. I got to find out what you're looking to buy. Once we have those assessments, then I'm not going to tell you what your rate is. We're going to jump on Zoom. I'm going to show you my computer screen, and I'm going to give you a loan comparison between your lowest cash to close, which is going to give you a higher rate, or your highest cash to close but the lowest monthly interest rate. And then I'm not going to make the decision. You're going to make the decision for yourself as to what rate you want to go with.
Right. Yeah. Do you want to pay points or,
As
Have you
opposed
used,
to 7.5.
Right.
And then we come down to it and you have a 680 credit score and you're trying to go conventional and you're going to get cracked 10 ways from Sunday. Right. No. So, but I think that's what's also allowing the industry for the hyper successful professionals to get that much more successful and pick up market share. Right. And then other brokerage models to have to shift stances to become a little bit more consumer direct. Right. But you're going to lose those consumer direct clients along the way because the real estate professionals are the ones that are pulling them and then recommending them to seasoned professionals, like Joey and I. So,
have you used Mortgage Coach before?
Oh, yeah.
Have you tried it? You
Love
still
it.
use it?
I know
Yeah.
Dave really, really well.
Oh, do you?
Dave Savage.
Okay.
Yeah, I've quarterbacked this stuff. We've jumped on with their Savage Insights and stuff like that. Yeah, they're great. I like MBS Highways too with Barry's. Their
I'm on there every day.
comparisons is in my opinion sometimes a little easier to read. But it's also understanding your audience, man. Like if I talk to a 800 plus credit score consumer putting 20% down, I'm gonna do a detailed analytic approach,
Total cost analysis
to exactly as opposed to respectfully an FHA buyer who knows the credit score is just not there.
Just happy to be buying.
Is happy to be buying a house.
Anymore.
You're still jumping on
American
Zoom with
dream.
me. Many clients are like, no, I don't have the time. I'll just take your opinion. No, you're gonna jump on Zoom. You don't have to turn your camera on. You could be on your cell phone, and I need to explain it to you. And clients are like, no, I trust you. Well, I appreciate that, but I want you because I might be telling you, hey, as I tell many of my clients, don't pay as much points. You're going to pay a little bit of points. It's just the market compression. But take this because X, you can qualify for it by industry guidelines, but you may only want to personally pay $3,000 because you're paying $1,300 in childcare for your kid. That doesn't report to your credit, so I don't know. It doesn't affect us. So we need to have that same conversation and get that firm understanding, and then you yourself make the decision as what works best for you.
I helped a borrower about a month ago, and it was quite a bit amount of points that he had to pay to get to a certain rate on a conventional. And I gave him the best advice, and sure enough, that thing went up like $2,500 in less than 2 weeks.
Oh yeah,
the points he would have had to pay.
Yeah, I get so many calls from lender A or lender B quoting, they'll send me hey, I spoke with my friend 6.5, send me an LE. And it's got to be locked. If it's not locked, I can put 2 on there. I'm like, send me the LE. And then surely, the lender starts, this, that. And then they call me and I'm like, told you, and it'll be tight on closing. And then, I'm usually the asshole that you're calling after you get hit with a TOE.
It's the same.
Yeah.
If a good analogy or good comparison is when you look at you look at this BMW, $485 a month. Whoa, and then you get there and it's $6,500
Yeah, down. Yeah, exactly. Let's
It's almost a half of a down payment of a house.
Yeah.
Yeah. What's the most you guys have seen in terms of points
So
that anybody's actually paid?
so the max you're actually able to pay
Okay.
is 3% on what's called a QM, a qualified mortgage. So anything that you have, and
That's
the
part of the whole
3% is
2008
also,
debacle.
and the 3% is actually minus the lender's underwriting fee, application fee, whatever the hell you call it, right? We charge about, I think it's like $1,800.
High price. It's considered
high priced.
High
yeah.
priced. Right?
So it's high price and high cost. So higher price is like 3.5. High cost means 5. So now in an investment property though, you can actually lock and pay points up to 5% minus the app fee and the commitment fee. Yeah. So 3 points is the max that you could pay for, and this is not Abdel, PRMG, Cross.
This is New Jersey.
This is federal.
Right.
It's a federal.
It's federal, right?
Federal regulation. 3% you could pay QM, and 5% investment. Yeah, you're not allowed to go now. DSCR, wild west.
Remember
my friend.
Right.
my mortgage term? That's part of HOPA, right?
What's that?
That's
Yeah,
right.
home
Right.
Homeownership Equity Protection Act. Yeah, it's higher price and high cost.
I studied.
Yeah, I love it, dude. I gotta know this stuff every
Yeah, 'cause you're
single.
training us, I'm asking you.
because I teach it and the NMLS every single time. Twice a week we jump on with them, Department of Banking and Insurance. Every Monday, and there's a lot of updated rules and regulations. Not necessarily laws, because we went through all that with the Dodd-Frank Act and SAFE Act and RESPA and TRID and all that, but a lot of changes. Right, you're seeing obviously. You were out of work, so for COVID. So, before that, if you were out of work for more than 6 months, you're screwed, right? You need to have established 2-year working history. Now it's changed, where if you're out of work for 6 months, if you're back at your same employer for 6 months and it's FHA, you're in the clear. You don't need to establish that 2-year working history. There are changes with maternity leave. Everyone's getting knocked up. So maternity leave. So if there's maternity leave and you're on maternity leave, as long as you're going to get back to employment within, VA allows 60 days. FHA or VA usually is before the first note date. Then you're in the clear. So those are a lot of the changes and regulations that we see, and then we just explain it as simple as we can.
With affordability being so low, right? What's your take on down payment assistance?
Listen, man, I hate them, but
Me too.
I talk about it consistently with our referral partners. Because I'll ask them, like, how's things going? But they're like, dude, we don't want to send you, and I say it with all due respect, but it's a lot of red tape, which is why I'm personally just not a fan. But, they just increased it from 15 to 22.
In New Jersey. This is national.
National. Yeah. In New
California,
Jersey,
you could get up to like 80 grand, but that's gone in after 10 minutes.
But it's, Cal Haffa, Florida just came out, right? There's a little bit of money in there with the Florida. But Jersey, so some areas were 10, some areas were 15. Now they jacked it another 7 towards closing costs, I believe. It's a lot of red tape, which is just personally sometimes why I try to say you have a better opportunity, Mr. and Mrs. Client, going seller's concession. There's no restrictions with your income. There's no restrictions in terms of affordability. There's no 5-year requirement. PRMG has its own down payment assistance too. Or we also have the ones with Chenoa. But I say, dude, like, I want to put you in a regular FHA 30-year fix, no restrictions. When we refi, we do a streamlined refi. We don't have to worry about any of that stuff. Or if you just have nothing, first of all, that's a flag in my playbook, because how do I know you're going to pay your mortgage? Second, it's just the reality, right? We're branch managers, so I need to make sure my numbers look good with HUD.
No chargebacks.
Yeah, but at the same time, like we were sharing the first time we spoke about, right? It's so much easier for you to get a seller's concession, right? And as long as we stay under the restrictions of, conventional 3%, less than 10% down, 6% for more than 10, 6% FHA, as long as we can do the calculations and it makes sense, it might be an alternative option. But, the clientele, so to say, within this hyper-competitive market right now, we're definitely seeing a lot more requests for DPAs and stuff like that. So
piggybacking off of that, right? I'm sorry.
No, go ahead.
Sorry,
what's
we're geeking out.
DPA? Because you're throwing a lot of terms.
I'm ready to geek out real quick. We got about 20 minutes left.
down
10
payment
minutes.
assistance.
Yeah.
Yeah.
Oh.
So
down payment assistance.
there's a lot of
Oh yeah, you're right.
the mother of invention is necessity, right?
Sure.
So with increased rates and the prices of the houses going up and the points that you have to pay for these interest rates, right? Affordability is at its all-time low, right? We all
Yeah.
know that. So there was a thing. I'm not sure. You can maybe quick 5 minutes. Community Reinvestment Acts, right?
Yeah.
Because no matter where you go, especially with Rocket, right? You see the commercials. We'll give you money to buy the house, right? They might as well start advertising that. So could you just give a quick explanation of community reinvestments and how a lot of these lenders are kind of sort of forced to have to provide down payment assistance?
So the CRA, right, Community Reinvestment Act, it's generally larger institutional banks that are more or less obligated to do them, right? I think I was on a month ago. Lakeland Bank was a big one. They actually had this
No
guy
PMI, no PMI,
This
5%
guy was
down.
like the CRA dude, literally.
Have you ever seen any of those close?
I'll be honest with you, we don't do them, so I don't know too much about them. I
But
just
that's the
know
one with no PMI
Yeah.
and 5% conventional, 6 credit. You could have just washed off ashore a month ago and they'll approve you. That's how they were selling.
Yeah,
it.
so the CRAs now, banks are not happy doing these loans. You know what I mean? But it's generally the CRA Act is predominantly for low. What do they say it? Like low and moderate income households. That's their nice way of saying things. So low and moderate income households, the CRA Act is usually what it, and the rates are ridiculous. I mean, they're super
Below par.
competitive. I think they're 5, 4.5, sometimes even lower.
Really?
But as I always say, a lot of red tape, right? We're in Jersey. I mean, I say nowadays, if you're looking to buy a $400,000 home, if you're not making at least 85, 90,000 with no debt whatsoever, you're not buying a house, right? Unless you have a cosigner or anything like that. I don't need to run your credit, Mr. Client, and pay $56 just to tell you you don't qualify. We're going to do Avenue A, B, C, and then we're going to do that. Or we're going to run a soft inquiry, and I'm going to tell you so I don't ding you at the same time. But the CRAs, I mean, listen, those rules and implementations are there, obviously, by the Fed. They're
just making the Fed happy, and they're placating them, and they're offering $5,000 a year, $4,000 a year.
Yeah.
I know there's one bank, all right, I won't mention their name, but I don't know, maybe the colors are green or something like that, and they were offering like $25,000, $30,000.
Wow.
We just need your blood type. Make sure you can see what you're going to sign. And I got sent this from a referral. Oh, we tried to go through them first, and a month later, sure enough, every week they kept chopping off. No, not conditions, but they offered them like 25, 35 grand as a down payment assistance. But the realtor was telling me that every time the borrower would call them, they'd be we don't have enough. Now it's 15.
Yeah.
Now it's 10. Now they're not even picking up the phone anymore.
Yeah, so that's why I say I try to truly if it's something that I can't control, I try my best to, navigate in terms of the seller's concessions or navigate in terms, because right now I'm not going to say never, because I think I locked my first one where the client only paid like $9 to lock her rate. 812 credit score, 25% down, single family home borrower. We locked at a 7.5 on Thursday, and she paid $9. And I literally had to refresh my screen. We use Poly, so we use Optimal Blue conventional.
Even with the adjustments?
Yep, 7.5. So 25% down, so no limited risk factor, 0.375 on the risk factor. 812 credit score, so no bucket risk in terms of that, and a single family home. So I had to refresh my screen like 3 or 4 times. And Poly
you'll get hit for it. You'll get hit for it.
Of course, yeah, I got a hit with a PE. So then I'm like, price exception.
That's not for me.
No, I know. But I had to refresh it, and surely it was there. And that was probably my first one that I think the client paid the least. And I keep my margins like this right now. This is not the 300-400 margins that you can charge. And we took it, but yeah. So those CRAs and stuff like that, I mean, they're there. I'm sure the consumer who can qualify for them will do them. That's just not my personal, preferred cup of tea, so to say. And could be because I'm not working for an institutional lender. So we're not really too familiar with those as much. So
What would be an institutional lender?
the ones that you're driving on the street and they're in the corner of the block, also the ones that are usually accepting deposits and stuff like that. Those are generally your institutional lenders.
Your PNC banks, your
Yeah,
Citibanks, your
yeah,
Chase. They have a lot of overlays.
Yeah, exactly. So that's true too, because
The less
sometimes
risk-averse
they won't.
mortgages.
So FHA, you could go 56.99, right? Debt to income. I know some institutional banks will only go like 50. So then I'll get So then I'll get a realtor who's calling me and they're like, hey, can you do me a favor? Look at this deal. And I'll look at it and then I'm like, wait, it works. Like, what the hell? It works. And I'm like, something's like, am I missing something?
Yeah,
like child support, alimony, like
they just took someone off their credit report that was there before.
And then no, it's just essentially lender overlay in terms of an overlay means a restriction. So they just won't lend 56, which is federal guidelines. They'll only lend 50, right? And when COVID happened, I believe it was the bank that starts with a C. They changed their credit score requirements to 700 and above, even for FHAs. Wow. So so obviously those are opportunities for consumers who don't have a 700 credit score. You can qualify.
Right.
So yeah.
So where do you see things heading to in the next, I would say, few months? What do you see? What kind of trends are you?
I think it's going to still stay the same. I think we're going to be in the same boat we're in right now. Maybe if that 10-year starts dropping down. Well, just I wanted to mention before for you guys. There's a lot of we do a lot of reading, right? I'm going to assume, right?
Yeah.
We do a lot of reading about the market. It's very complicated. Here's the gist of it. When you hear good news, it's bad news for those who want to buy houses. When you hear bad news, it's good news for those that want to buy houses. So if you're hearing bad news that inflation is going down, that's actually good news, right? That one thing. But if you're hearing there's a lot of people losing their jobs, rates might get better. If you're hearing that there's a lot more people filing for unemployment, rates might get better. When you start hearing about, it doesn't really affect us as much, but you start hearing about subprime car loans, you're going to start hearing that term a lot in the next couple of months. That people are defaulting, that might be good news.
Yeah, no, it's a great point. I mean, it's always it's an inverse relationship. So if mortgage bonds, go up, interest rates go down. If more people are filing for unemployment, holy crap, the Fed's going to be like, cut, right? Or pause. If, what else? More homes start coming on the market, so to say, what is that going to create? An influx of buyers coming in, which is only going to allow you to build. And that's what's going to happen. I mean, the reality of it is rates are going to go down, and you're going to go back to competing 10, 15 offers. Now I maybe compete with 3, 4.
Yeah, that's what I've been saying.
Right? 3 or 4, I would say.
Back to 2001.
What's that?
We'll be right back in 2001.
Yeah, 2021. Well, 2021, 2021, you're competing, dude, easily. I bought my house. I think I shared it last time. Bought my house down the shore. I offered 65 over, 7-day closing. Didn't do we did an inspection, informational purposes. Waived the appraisal. Sellers can stay there for free for a month. And I'll take out all your crap and throw it out myself. It's gonna go back to that. Now, luckily, when I bought it, the house overappraised by 70. We got the clear close in 3. Obviously, it's my stuff.
Was that just the luck? Was that luck, or you did your?
I did a little bit of due diligence.
Okay,
just a little bit. I kind of knew the client a little bit.
Okay.
But let the seller stay for free. You got no choice. I mean, you're walking in. It's a 5-bedroom, 4-bathroom house that's down the shore. So you're like, oh shit. Right when I walked in, I already knew. I'm like, yeah, I'm gonna have to go. And we're always going 30, 40, 50 over on every home. So it's just part of the game.
Yeah.
You're gonna go back to that. And in some areas, man, I'll be honest, it's still like that. That's the other thing. Like people don't. If the house is priced correctly, which is the most important thing, if the house is priced correctly and the inventory is tight as it is specifically in Jersey, almost everywhere, you're still fighting tooth and nail, right? And you're still going 25, 30K over. Many of my clients, I tell them, dude, we got to waive it. You got to waive the appraisal. No gap, none of that stuff. You got to waive it. ran the comps with your agent. Comps look strong. Comps look good. We handpick our appraisal management companies. We put the appraisers on the panel, so they're cool dudes. If it under appraises, we'll negotiate. We'll do a reconsideration of value, stuff like that. But if you're a client or a professional, those are the conversations you need to be having with your clients right now. So they don't think about, oh, it's 7.5. Oh, it's 7.75. I haven't clocked the client at 8% yet. The highest I've done is 7.9. But you got to have those rest assured understanding, because March, April, I want to say, because it's like I said, 4 months. So we just paused again. Don't hold me to this in 2024, and you call me and be like, what the hell? Like we did to Barry in May, right? When he said the rates were going to get cut.
Oh, yeah, they crushed them. Everybody crushed.
Yeah. But I think we'll certainly see a very, very, not a sharp decline, but we may potentially see like low 7s, maybe even high 6s.
Don't listen to CNBC.
March, April. Yeah. And listen, the media's job is to.
What's her name? Anna Coldrick?
I don't know, man. I try, like, I'll be walking in a gym on a treadmill, and then I just turn off the TV. The TV in front of you.
Yeah.
I turn it off because it's either the international policy happening overseas that's been happening for 60 years, and then I'm just like, nope. And then I'll watch whatever, something on Netflix or MBS Highway or something like that. But yeah, so that's kind of my take on that. But it's going to create very, very high demand. People are going to have to go over asking. The sellers,
you foresee it for the next. I kind of see the same. It's going to go to 2026, 2027.
I agree. Yeah, because housing prices are going to just go up. They're not going down. I'm
sorry
pretty sure
to break the news.
Right. So if you can buy something, buy it now.
Yeah. It was 80 years. I might have shared this last time. In the last 80 years, home prices appreciated 73 times. And 5 of those 7 years were after 2007 of non-appreciation. And 1 of the other 2 was a 0 appreciation or depreciation. So technically, in the last 80 years, only 1 time, or I guess 75, not counting that, only 1 time home prices dropped.
Wow.
And
but
just
it's going to start a whole other conversation. But houses aren't supposed to be appreciating at 10% year over year.
Yeah, I mean, but listen, there's just
unless you're in the seller's market,
there's just not a lot of them. That's the reality of it. It's the true, and at the end of the day, it's just basic economics. You have a very high demand and a very short supply. And once interest rates start going down and consistent people keep losing their jobs, we had to unfortunately let go from a corporate level 2 underwriters and 2 closers last Friday. So you're seeing that, right? And it could be just plumping and better systems and whatever the case may be that may be implementing, changing things around. But you're seeing a lot of different people. Like I said earlier, unemployment went up. And it went up quickly the first time in the last 8 weeks. Are we also getting finally real data? Because all the data before was crap.
Right.
It was all fake. And we knew that because they were getting revised every single month or every single quarter. Oh, sorry, guys. Yeah, we said that there was 330,000 jobs, but we double counted jobs and it was only actually 85. And you're like, dude, that is so messed up because I just locked 3 or 4 clients who just closed at a higher interest rate than I really should have. Not because of my margins, but because just outside market factors, nothing I can control.
Was there a case where people, like with the remote work, where they were double counting certain jobs because they were
working from home and working from there? Yeah, 100%. But you generally also too during the winter time, statistically, people tend to also get laid off.
There's gonna be less inventory right now.
Yeah, that too. 100%. But talking about employment, people tend to get laid off.
During
around
the holidays?
these times. Yeah,
wow.
100%. Yeah, because now you're
I come from retail. We always hire.
Yeah. Well, you're thinking into
hire.
like you got to hit budget numbers, and how do you? If your budget is not there, what do? You slice salaries. That's the fastest thing you do before diving into supply chain management and all that stuff. You start slicing salaries to meet certain quotas, or you say, "Hey, we messed up. We didn't hit it, but we just fired 4 people, and the other 3 that are still there assumed all their 4 jobs and their 4 salaries, and now we're saving." Whatever, $200,000 for that. So
awesome. Now, how can people get in touch with you if they need to find out more of, or apply for a mortgage?
Yeah, gotmortgages.com. It's my website. Not hard to find online if you search my first and last name. My office is based out of Eatontown. We do lend throughout the entire nation, like I mentioned earlier.
Yeah.
And that's it, man. I think it's just truly giving. And I'm a firm believer. Like, if you're in a better position than you are renting right now, like some of these clients I talk to, dude, and they're like, yeah, I got grandfathered in, right? I've been living in the same place for like 5-6 years. I'll be like, dude, stay put.
Yeah.
The reality of it. Just because I'm like, even if you go to buy something, even with rates high, and then you're gonna refi, and that slogan that we all know, right? Well, not even that, but like date and marry and all that stuff.
Oh,
what? Oh, you're wearing a shirt?
Dude, what did I tell you earlier?
I read that wrong.
But I tell
It
them,
was a great idea when I first did. I knew it was going to become the Steve Urkel of real estate memes.
but it's like, I mean, some of these people, like, they're paying like $1,400 for a 2-bedroom, and I'm like, can I move in there? Like, I need a place up here. I'm always up north. So I tell them, like, listen, honestly, I think maybe you should stay put, save a little bit more money, stuff like that, right? Or let's make sure, if you're self-employed, let's make sure you're strategically filing correctly, right? You're adding things, depreciation, stuff like that. So it's just coming with true sound advice, right? As opposed to looking at you from a dollar figure. You're not a dollar figure. We're a lender for life, and we're going to take care of you truly from the start to the finish. We take it from there. So.
It's almost we're
Awesome.
basically financial advisors without the licenses.
Yeah.
Legally we're not, but
well, I used to legally be a financial advisor.
so you would know, right?
Yeah.
We're giving a lot of the same information. It's not just believe me, not to hate on any of the other lenders or the consumer direct lenders, right? It's not just uploading W-2s and tax returns and waiting for your interest rate, and it's a lot more than that.
Yeah.
Unless you're putting 50% down, you're buying the house from your relatives, and it's just a skateboard transaction, and most transactions aren't.
No, especially not now. Yeah.
Yeah. And how did they get in touch with you, Joe?
Joseph Fowler, also easy plug if you are looking to find out how much money you can pull out of your home based off the Biden appreciation. It's called the CCM Easy Equity Express. You can go right on my website, Joseph Fowler at CCM. You'll find me. Joe does mortgages on all social media. If you're looking to buy your first primary residence, your primary residence, or you're looking to buy an investment property, I can be reached at 908-669-9091.
Awesome. And Vlada?
Finally got my Insta handle changed
Yeah.
to vlada.a.kobileva. You guys can follow me there. Or shoot me an email, vkhomebuyersusa@gmail.com.
Just before we go again, just for the both of us, right now is the time of scenarios. I try to explain that to my real estate agent. Now is the time for scenarios. Most chances are you're probably not quite ready right now, because where interest rates are, but let the lender do a scenario for you so we can put you in place once the time becomes available. Say you're starting a new job. You don't have enough down payment. Maybe a down payment assistance program may not be ready for you now, work for you now, but maybe it'll work for you down the road. There's a lot of different factors and different things that we can do to help you, but run the scenario. Please just don't sit on the sideline.
Yeah.
It doesn't cost you anything.
I love it.
Yeah.
All right.
Absolutely.
We'll wrap up after that. Sorry.
No worries. And I'm Joey Chan here at Kitchen Design Lab. We do kitchen cabinets, countertops, and installations as well. So, guys, thank you.
Also, if anybody has any deals out there that they'd like for us to analyze for them, an investor deal, especially since that's our core audience, shoot it to us. You know how to reach out to Joey on Facebook, phone number. Let us know.
Yeah, absolutely.
We'd love to run the scenario.
Yeah, we're going to have a guest next week, is Amit Darji, and he does a lot of fix and flips, primarily closer to you, actually, down in, just outside of Philly area in New Jersey. So, we're going to be discussing more about fix and flips and things like that.
Awesome.
Next week.
Boom.
Guys, thank you.
Thank you.
Thanks, guys.
All right.
Great.
Yeah, nice to have you.
All right, let's make sure I hit record.
It gets hot.